Good afternoon, everyone. My name is Brian Overby. I am the Senior Options Strategist at OptionsPlay, and I'm also the author of the Options Playbook. On today's event, we're going to be talking about rolling covered calls. It sounds like a simple little thing to do, but there are a lot of little nuances that you need to understand if you do want to roll covered calls like a pro. Yeah, that was a little cheesy, but bottom line is we're going to cover those things. This entire event will probably last about 40 minutes. I do have a tendency to answer too many questions when everything is said and done. And that leads me to a little bit of housekeeping items. There is a chat box. It's open to everybody, but mainly if you want to ask a question, it's much easier if you use the Q&A box. And you should see that on the bottom of your Zoom screen. It basically has a question marks on it. And I'm going to pay more attention to the Q&A box than the chat box. And I do know that there are quite a few people out there and a few that will log in a little bit late. But with that said, we will address everything at the end of the show more than likely. Now, I'm going to keep an eye on it, and if I do think that the question is pertinent to the seminar, I will bring it up. And okay, everybody else seeing my screen at this point in time? I got one person saying they cannot see my screen. You should see a PowerPoint that says rolling covered calls like a pro. All right, most people can see it. Just so you know, Michael, it's on your end. All right, let's begin. Nothing is meant to be a recommendation today. We're going to look at actual quotes using the OptionsPlay platform today. That is not meant to be a recommendation to buy or sell any securities. We're just using it as an example to understand rolling covered calls. All right. Please get your phone up now. I will show you this QR code a little bit later, but you might as well go and sign up for the OptionsPlay free trial. It's free to you, and you can explore everything that I'm going to show you today on today's webinar, as far as even a paper trading portfolio, and that's what I'm going to highlight today. I'm going to place a paper trade covered call on JP Morgan, and mainly because JP Morgan has already announced earnings. So the call options are not overpriced because of the known event, and we're right in the heart of earnings season right now as far as the markets are concerned. All right, so you can scan that, and I'll give you one opportunity to do that later, or just go to optionsplay.com/signup. All right, here's the agenda for today. We're going to start by looking at a covered call. Then we're going to talk a little bit about the vernacular of rolling an option contract. And then we'll do an example. It'll be a simple XYZ example. And then we'll talk about the types of rolling. We can roll up, we can roll out, we can roll up and out. And then we're going to actually look at that on a real life example with real markets. Now, the markets would be real time, but they are closed at this point in time. So everything is real time, right? So in general, that's the way that we're going to approach it. And then I'm going to try to address your questions. So let's get to it because we've got a lot to cover. So here's the 4 basic positions in an option contract. And we're going to focus on owning stock. So this is actually a seminar that could be titled Options for the Stock Investor. And I personally think that covered calls is one of the first trades that any beginning option trader should do. But in order to do that trade, you need to understand the 4 basic positions. And here's the first one. Most people that are thinking about trading options come in and they want to buy a call option. Why not? You get a lot of leverage. You get the right to buy. You get to participate in a stock like JPM, which is a $250+ stock, and you get to control that stock for a limited time period. So if I'm a buyer of that call option, I'm also considered long that call option in the account, and that means I have the right to buy. So if I buy a call, I have the right to buy the stock. That means I'm bullish on the underlying. Now, on the opposite side of the coin, if I sell the call, guess what? I'm going to be bearish. But when I sell, I bring in cash. For that cash, I take on an obligation. That obligation is to sell stock, and that price will be predetermined. It'll be the strike price. But what I'm saying is that if you pay me cash now, you can call my stock away from me later. And that's actually where the term call comes from. It comes from this obligation from the seller of the option contract. Once I've sold that option contract to somebody, I'm considered short that in the account. And just a little tidbit to add on to that, sellers are a lot of times referred to as the writer of the contract. And that's all that options are. Options are contracts. And that term comes directly from the insurance world. In the insurance world, if you buy a policy from Allstate for your car insurance, they call Allstate the underwriter of the policy. And they take on an obligation, right? That obligation is to give you a new car if you happen to run it into a tree. Well, in this instance, the obligation's a little bit different. People can call stock away from you. So this is the biggest one we're going to be focused on. The seller of a call option takes on that obligation to sell stock. And we want to avoid that obligation. So we're going to talk a lot about that obligation. And then just to complete the slide, on the put side of things, if you buy a put, you have a right to sell. So buy means sell with puts. That means we're going to be bearish on the marketplace, but you are still considered long once you purchase that put option. And then on the other side of the coin, if you sell a put, you are considered the writer and you take on an obligation to buy. Now, this is where insurance really comes in. If you think about a put option representing 100 shares of stock, if the stock goes down and you sell that put option, your obligation to buy the stock at a higher price called the strike price and have that stock put to you. So once again, call and put comes from the obligation that is created from the seller of the contract, otherwise known as the writer of the contract. All right, so let's get into an example. Now, I cut and paste this today from JP Morgan because this is going to be the stock that I'm going to work with today. Now, like I mentioned earlier, a lot of the financial stocks have already announced earnings. And when you have earnings, we'll talk a little bit about this at the end, but option contracts get a little weird and they have a higher implied volatility. So I wanted to deal with an option contract that didn't have any major known event ahead of it. So I decided to pick JP Morgan. JPM is a good old symbol, and we're going to look at some covered calls in that position. But this would be a covered call option that you might do, and you could find inside the OptionsPlay platform. But quite simply, you're going to be owning 100 shares of stock. Now, it's very important that you own 100 shares. If you own 50 shares, you can't sell a call option on it because the option contract represents 100 shares of stock. The expiration date that we're going to use, like I said, we took this as of today, but we're going to look at the February 21st expiration, and that's 22 days away. So I'm going to buy the stock and then at the same time sell this call for $2.19. Now, these are the midpoints for the underlying stock. So we're basically saying we got a really good fill on this trade. And if we do that, we lower our cost basis. Right now that we'd be buying that stock at $268.43. Our midpoint will be reduced, or our cost basis for the stock will be reduced by the amount of premium received, $2.19. That means that our total cost for the trade would be $266.24. It represents 100 shares in one contract. So in this instance, it would be $26,264, and that would be your max risk for the position, just like if you own the underlying stock. Okay, now if I do this trade, here is the profit and loss graph that is generated inside the OptionsPlay platform. And what we're saying here is that we're willing to give up this upside, right? This upside from here on up for receiving the premium here. So you can call the stock away from me if it runs up to the 75 level. I will take on that obligation to sell my stock. Maybe I wanted to sell it at that price anyways. So the call option in this instance, which is very important to me, especially if we're going to talk about doing covered calls around earnings, that call option does not hurt my position. I can still sell the stock. I can still get out of the trade, but all the risk from a covered call comes from owning the stock. This is the downside of owning the stock. The covered call just brings in some premium, lowers your overall cost base of owning it, but you lose an opportunity if the underlying stock moves up above the 275 level. Now, some people sell covered calls and they don't want the stock called away, even though they're saying we will take on that obligation to sell that stock at 275. Now, when we do this, this is where, I guess this is the theme that's behind this presentation today. There are some things that you can do to try to avoid assignment if the stock is approaching the 275 strike. And you say, all right, there's still days remaining to expiration. DTE stands for days to expiration. That's a acronym for it. And if expiration is approaching, but it hasn't approached yet, and the stock is approaching the 275 strike, well, then we got a situation if we don't want to get rid of the stock. All right, so that is about it on the basics. Kind of assume that most people would know what a covered call was if they're looking at how to roll a covered call and rolling options. Now, to start with, and this is I think something that gets skipped over a lot when people are talking about rolling covered calls, is early exercise and assignment. Why am I worried about rolling this covered call? When does this potentially happen? Now, I have a section inside the option playbook that goes into a lot of detail on it, but I'm going to give you some detail on this slide. Okay, so here's the three reasons why here are three reasons why owners of option contracts, calls in particular, do not exercise calls when they become in the money. So here's our scenario in our JP Morgan example. The stock is now at 276. That means it would be 1 point in the money. We still have 5 days remaining until that expiration date. And when that happens, some people might assume, well, take my stock away. I want the stock to be sold. That's why I sold the call option. And some people will do that for a reason, and they want to be exercised right away. And they want to be assigned, and you take my stock away at that price. Now, why wouldn't somebody do that? And here's the three main reasons why, and some reason why they might, okay? So, for example, they want to keep the risk limited. If I buy a call option and the stock goes in the money, I know that I can buy the stock, right? I know the price that I'm going to buy it at. So if I exercise and say my intention is to own the stock, so I guess I should set that up a little better. So I want to own the stock and my goal is to buy the stock, but I bought this call option and said, well, if the stock reaches this price, well, then I'm going to exercise and then I'm going to buy the underlying stock. I like it at that price, but I don't want to miss out on any opportunity that might happen and the stock skyrockets and I don't get to buy it at all. Okay, so I buy that call option. Stock comes up and now it's 1 point in the money. If I exercise now, I still got 5 days remaining to expiration. If I exercise now, well, I'm going to buy the stock at the strike price and I'm only 1 point in the money. What if 5 days from now the stock goes down 2 points and becomes out of the money? God, I really look silly then, right? Because I could have waited and then in that scenario just let the option expire worthless and then in that instance, if I let that option contract expire worthless, I can buy the stock on the actual marketplace 1 point lower than where my strike price was at. So if an option contract becomes in the money, there's one big reason not to actually exercise your option contract and buy it right away, even though I might want to buy the stock. The second reason goes hands in hands with this. Spend cash now or spend cash later. Right? If I exercise my option contract, I got to put out all the money to own the underlying stock. So why would I want to spend cash now when I can spend cash later? Most people would prefer to put off any buying of the stock until the expiration date and be able to use that cash up until that point. And then lastly, there's quite simple. One of the things is you don't want to miss out on the time value. If you're thinking you just want to get out of the position and you don't want to actually own the underlying stock, why not just sell it in the marketplace? There's a the Chicago Board Option Exchange in 1973 opened up their doors and first started trading listed option contracts and made a viable market in order to buy to get in and sell to get out. And this is actually what happens the most often is people just don't exercise. And if they don't exercise, someone doesn't get assigned and they actually just sell it on the open marketplace. All right. Now, if I'm a covered call seller that doesn't want to be assigned, this is a good thing. I like the fact that it can get in the money and I can adjust my position and not be exercised by the owner and assigned by the seller or on the seller on my option contract. So there is a time when assignment may happen early, and it's really if you're dealing with big dividend paying stocks. So here's the one reason why they might. A dividend payment is approaching. So on call options, if you own a call option and a stock pays a dividend, the stock goes down by the dividend, but the call option does not get any benefit to that. Now, you make an argument because of the dividend and everybody knows that the dividend is going to be paid, the call will be priced accordingly. And there's 100% truth to that. But you know that if I do want to own the stock, maybe I do want to get the dividend. So I might exercise before the ex-dividend date just because I want to receive the dividend, especially if it's a large dividend. So you need to know the date that you want to look for is the ex-dividend date, and you want to look at how much time value is in your option contract, the amount of time premium left, and this is what we're talking about when we sell that option contract, versus the size of the dividend. If the dividend is big and it behooves somebody to exercise and get the dividend because it's worth more than the time value you'd receive by selling it in the marketplace, they might exercise. It actually is a very astute thing to do if you are an option trader that wants to own that underlying stock. So, one of the biggest underlying stocks that we see this happen in a lot, because there's a lot of very sophisticated traders in my years with all the brokers that I worked with, brokerage firms, is the SPY, the S&P 500 index. The ETF that tracks it actually pays a dividend. And there's not a lot of time premium in it because it is an index. So a lot of times as expiration is approaching and that stock's going to pay a dividend, you will get assigned early if your SPY call option is in the money. And if anything, it just really annoys you because you're hoping that it would go out of the money and you'd be able to actually keep your underlying stock. So that is one underlying that I see it happen quite often in, is the ETF, the good old SPY, the most liquid option trading contract actually in the retail market space, period. All right. So any questions on that? I'm going to pause for 1 second. Okay, I got the name of the book. The name of the book is Options Playbook. And I'll show you this. I'll show you the website in just a second. And you don't necessarily have to buy the book because I actually give it away. I still sell a lot of books, but I give it all away on OptionsPlaybook.com. So let me just talk a little bit about exercise on assignment. And I'm going to use the playbook to do that. Okay, so in this section inside the playbook, it's called cashing out your options. And if you want to find it, you just go in here, type in cash, and that section will come up, or you can obviously go through the tabs. But with that said, cashing out your options. And the biggest thing that I wanted to show you is this chart. Now, this is a little bit older chart, but the numbers have not changed in a long time. I used to work right next to the Options Clearing Corporation when I worked at the Chicago Board Option Exchange. And every year they post these numbers. And most of the time, they really don't change much. Even with commissions going down on buying stock, all that type of things. If you buy an option contract, most people don't want to buy the stock. So if you buy that call option and it goes up, most people will close out the position. 70% of them will. And then about 11% will exercise their option contract. That means that if it's a call, they're going to be buying stock. If it's a put, they're going to be selling stock. And about 19% of the time, the options actually expire worthless. So there's always this misunderstanding that I hear 80% of all option contracts expire worthless. That's just simply not the case. And if you think about the way that you trade options, how often do you just let an option contract go all the way to expiration and expire worthless? It just, most of the time you adjust it, you close it, and it's a contract. It's not a hot potato that's going to end up in somebody's hands and it's got to expire worthless. That's what an 80% of option contracts expiring worthless would imply, that somebody's going to end up with it. It's a contract. It's just like an insurance policy. If I don't want to have my Allstate insurance policy, I can close it out and go open a new one with Geico. That policy ceases to exist as soon as I tell them, I want to send me my premium back, I'm going to close out that contract. And that's the way option contracts work. And this is a little bit of insight into how open interest works and how the vernacular is in the options contract. Why do I got to put so many things in my order ticket when I'm actually trading options? So if there's any questions on this, I mainly showed this to just try to get rid of the biggest misnomer that 80% of all option contracts expire worthless. That's just silly. And if you even think about it, if you got a call option with this strike and somebody's got a put option on the other side, well, if the call option expires worthless, well, the put option's not going to expire worthless, right? So it's all about open interest and how you track it and everything that goes along with it. But most of the people will buy an option contract and open a position, and then they'll sell an option contract and close a position. That's simple. And the numbers say it. 70% of the time, that's what happens. All right. So, so here's the vernacular that I just talked about. So let's go back to a slideshow. And and it's really what I had a good segue into it from the options playbook. Why are option order tickets so complicated? Well, it has everything to do with exactly what we're talking about. Options are contracts. So in order to, if you're looking at a contract, you can easily be the seller of an option contract just as much as you can be the buyer. So the Options Clearing Corporation that manages the whole clearing for all the exchanges wants you as a broker to send to the trading floor that we're buying to open, selling to open, or buying to close and selling to close. Because in a covered call situation, what we're doing is we're selling to open, and then if we want to remove the obligation, we're buying to close. And if that happens, and I put buy to close, they know to look at the options, the open interest, not options, the open interest, and the open interest is going to go down by one contract on your side of the equation. Now, there's hundreds of people that are doing this, and here's one of the things that one of the other misnomers is that if I go and I sell an option contract and somebody buys it, when I go to close it, they don't have to close it, right? Somebody else in the marketplace can close it. So what actually happens is at the end of the day, the Chicago Board Option Exchange goes and looks at all the volume, looks at all the tickets that were marked opening, all the tickets that were marked closing, and then they post a new number called open interest. Some days that number goes up, some days that number goes down. But the volume is a live number that happens during the day, and the open interest is a number that happens overnight and is calculated. So that's how open interest and all that works. And this is why you have to mark your tickets buy to open, sell to open, buy to close, sell to close. Now, there are some brokerage firms, and you might say, Brian, my broker doesn't do that. Well, there are some brokerage firms that do it on the back end. But when that order comes to the exchange, it is marked open or close. It has to be. That's the rules of the exchange. So your broker might be noticing your positions and sending it to the floor that way. But in general, this is the way trade tickets have to be marked. All right, and then these are all the short versions of it, right? Buy to open BTO, STO, BTC, STC. All right, just want to make sure you know that because I'm going to use that later on. So let's look at a rolling covered call example. What am I talking about? What might happen here? So in this instance, I own 100 shares of XYZ stock. I sold the 90 strike call. I bring in $1.30 for that. All right. And the stock price at or the stock price at the initial sale of XYZ, which XYZ is a generic stock in this instance. The stock is at 87.50. All right. Now, expiration is approaching. 90 strike call, we have an obligation. We turn around and we notice with we'll say 5 or 6 days remaining to expiration. We'll say 6 days. That's an easy number to say. XYZ is now trading at 92. If I don't do anything, the stock's going to be called away. Some people might be okay with that. Go ahead and take it away from me. That's no problem. I don't mind selling my stock at 90. But now we look at the call option, and because that option is now in the money, we see that it's trading for $2.10. So we're down on the position. We sold it for $1.30. We'd have to buy to close it for $2.10. We would make money on the stock that we own, but we would lose money. We'd lose 80 cents on our option contract. And a lot of people don't want to lose that 80 cents, right? So if you're at the blackjack table, what are you going to do? You just lost your $5 bet. And now you're going to go up and you're going to double down, and you're going to place a $10 bet. And hopefully you win the next hand and you're at break even. That's kind of the concept of rolling covered calls. I want to be able to roll this position, go further out in time, go a little bit up in strike, and that's the first and probably the most popular way to do option contracts. But I'm going to roll up and out, and I'm going to try to get this done for a net credit to the account. And if the stock doesn't get up to the new strike price, well, then I just doubled down and basically either got out at break even or brought in a small credit to the position. So in this instance, we're going to get it done for a small credit. We're going to buy to close. So this is the way our order ticket goes into the trading firm. And I do see, man, a lot of questions are coming in. So in this instance, let me get through this thing and then I'll go back and look at some of the questions and I'll see if I can try to keep up with them. So in this instance, we're going to roll up and out. And like I said, this is the most common thing to do. We're going to buy to close the 90 strike call for $2.10. We're going to remove that obligation. And then we're going to sell to open the 60 strike call. But now remember, we got 6 days remaining to expiration. We're going to roll, in order to get enough premium to cover the cost of this call, we got to go out 60 days because we're going to go up because the stock's already at 92 and we're going to go out in time, adding time premium to that out of the money option contract. So by doing that, we can then sell that option contract for $2.30, and that's creating a new obligation. We get a little bit more upside on the stock, right? The stock is now at 92. And in this instance, instead of giving up our stock at 90, now we'd have to give up our stock at 95, 3 points higher. And we were able to do this for a net credit of 20 cents to the account. Now, there are a lot of things to think about in this. And one of the biggest things is you can't assume that the stock's going to continue to go on up, right? You did book a loss in your account. And that's another thing that a lot of people don't realize is that if you do this, you are taking a loss on this call option. You're making up for it if you sold the stock right away, but most people aren't going to do that, right? That's the reason why they rolled it. They didn't want to sell the stock. And now you got all the risk of still owning the stock. If the stock goes down below 90, well, then this was a bad situation, right? If we go out 60 days and all of a sudden the stock's trading at 85, we lost on this situation, and we also lost on our stock. And the situation, what I mean is our first call option. So we have a loss on that, and then we have a loss on the stock if the stock is down at 85 at this expiration date. So always be aware that when you're rolling, it sounds really good, but you're still booking a loss in your account for that call position. All right. I still prefer to do this, and I do this a lot in my own account where I roll calls on positions that I don't want taken away. Okay, so with this said, now we bring in a net credit of 20 cents. And I very rarely want to do this scenario where I can't get it done for a net credit. And so that brings up the different scenarios that we can do to try to create a net credit in the account. Okay, so the next slide I'm going to talk a lot about. So let me go and address some of the questions here. Okay. Anonymous attendee, Mr. Anonymous or Mrs. Anonymous says, can you talk about open interest? I think we did that. So we answered that live. We're done with that one. Where do I find slides and can I print them? We will send out slides. Someone from OptionsPlay will get them to you. We can do that for you. You can send in a request to have the slides sent to you. I do think we're going to send them out on OptionsPlay. Let me know for sure if we're sending them out. I'm kind of new to the OptionsPlay thing. All right, where do I find slides and can I print them? No. Can I open a calendar spread? Okay, I'm going to use that one later. Okay, so here's a great call from Michael Katz. And Michael says that way back when I said something about putting in a roll closer to the close, and that is usually the case. So in other words, if I'm trying to roll this position and I'm trying to get it done for a net credit of $2.30, sometimes as the marketplace is closing, when you're looking at a spread position, market makers are more apt to fill that trade at a good price, somewhere close to the midpoint, than they are at noon. Mainly because at the end of the day, they want to reduce risk. And so, yes, Mike, that would apply. That would apply in this situation. If you are closer to the close on any type of spread transaction, there is a better odds are higher of doing it closer to the close. And then we got some tax questions. I can't really address the tax questions, by the way. So yeah, tax questions are tough when it comes to covered call writing. There's a lot of little nuances that are in it. Okay, so Joshua is asking, and this is an okay question. It's a little bit advanced, but I'll address it right now. What if you sold a covered call and the stock has skyrocketed past the call price, but you still have 5 months to go? Is there any way to avoid getting called? No. In that instance, in that the stock has gone too far beyond your premium. And the way that I'm going to address this is I'm going to assign you some homework, okay? So if I'm looking at rolling a covered call, one of the biggest things that I highlight at the inside the trade is you don't want the stock. Let's see if it's in this section. You don't want the stock to get more than 2% in the money. And that's a general number. That number will happen. That number will change based off of the dynamics of the stock. And by dynamics, I mean the implied volatility, how much time you have remaining on your option contract. But if the stock runs up too much, and I'm going to show you this when I do a real live example using JPM, it is very hard to roll this position for a net credit to the account, especially if you're going to try to roll up and out beyond where the new stock price is at. It's a very hard thing to do because you have to buy a lot of deep in the money. You got to pay a lot for deep in the money option contracts. So I highlight that in this section, but I'm not going to scan through and kind of show where it's at. Managing positions. Introduction to rolling is where it might be. Okay, so these are the two sections where you might be able to find and read a little bit more on it, but I'm going to get into great detail here. Okay, so this is where the types of roles come in. All right, so on, I don't know who, oh, that was Joshua that asked. Okay, Joshua, here's the one thing that you can do, but you really painted a sad picture because you're saying you got 5 months to go, right? 5 months is a real long time. And I usually won't sell calls that far out just because I want to be able to control the situation a little bit better. So the most that I would go out in time would probably be 90 days. And more than likely, I'm going to go out anywhere between 30 to 45 days. That's always just a nice little sweet spot for covered call selling. And the reason why I say 90 days too is a lot of times I want to avoid earnings. Very rarely do I want to be in a position where I am short a call option around an earnings report. And that just simply comes from looking at the profit and loss graph. You receive a lot of time premium for selling call options around earnings because of that known event, but you also own the stock. And so you have a capped upside and you have a lot of downside risk from owning the stock. And I don't like that scenario. So I prefer to not sell calls on a long stock position around earnings. I don't mind doing it. I'm not saying you should never do it. There's never a never really in the options trading world. But I personally try to avoid it. So if I'm selling call options, I'm usually going to sell them 30 to 45 days out. Or if it's a very volatile underlying, I might just do it a week or two out, just because you're going to get enough time premium to make it worth your time to do this. So here's the reason why I bring this up is that here are the type of roles. You can roll up and out, which is the most popular one. And I'm just going to highlight it there with my cursor. You can roll up and out, and that's usually the goal. Like in our example, the stock got a couple of points in the money. And so when that happened, it made it a little tough to roll up and out and get a decent credit. We could only get 20 cents in our example, but we were able to go up to the 95 strike. And we gave our stock a little bit of upside, and we didn't have to pay for the roll. So I don't mind that roll at all, and I would do that roll all day long, and that's why I made that an example inside my book on rolling covered calls. But sometimes you can just roll out. So let's say in that scenario, we couldn't have got the up and out done for a net credit to the account. What we could do, and let me go back to this example, is instead of rolling to the 95 strike call, we could just roll to the 90 strike call that's 60 more days out, right? So the 90 strike call right now with, I said 6 days remaining, was trading for 210. That's why that's happening, is because I don't have the slideshow. It's trading for 210. I was wondering why it kept showing me the box. I apologize. If I want to avoid assignment and I look at this scenario for 60 days out and I see that, oh my gosh, this is trading, let's call it 190, and I can't get this done for a net credit. If I feel some weakness in the stock, I might roll out. We're going to use the same example. It doesn't necessarily have to be 60 days, but we're going to use this because this is the example, and roll to the same strike. Because of everything that I just talked about, the stock is in the money. The odds of getting us exercised early is very low. So why not give me some time for the stock to come back down and get paid for it? So I can just roll out, and if I do that, I'm really bearish on the stock. I'm saying I'm going to roll out, I'm going to bring in an amount of premium, and I hope that the stock goes back down below the 90 strike. And that's one thing that you can do, and that's rolling options as a pro. If you do think that, oh my gosh, the stock just made this little run up, and I do think that it can come back down before the 60 days, or if I want to do 30 days, it's totally up to you. Well, and if it doesn't, oh well, go ahead and take my stock away. And that would be kind of your last hurrah at keeping the stock at that point in time. So you just no longer roll up, you just roll out on that position. Okay. And then the other situation, and I do this a little bit inside the OptionsPlay platform, but I use it a little bit more on wide call spreads, and where I am long a call option instead of long the stock, and the stock has gone up. So I will roll just up, but stay in that same expiration. Okay, so in this instance, it's usually a preemptive roll. So if I'm going to roll up, I'm not going to let the stock go to 92. So in this scenario, and I'm going to try to work through these live on the OptionsPlay website. I hope that everything, it's a big drag to have Zoom running on the site while I'm trying to work through those scenarios, but I'm going to do it. So in this instance, if I'm going just up and I'm staying at that same expiration, I would want to do it when the stock reached 89, right? I don't want to let it get in the money. And all I'm trying to do is, if I roll up, I'm probably going to pay a little bit of a debit for that trade, but I'm hoping that I can let the stock run a little bit more. So this is probably the least common thing to do, is to roll up. Now, in my scenario, like I just said, I have, let's say, a wide spread, 20 points wide. Stock has moved up quite a bit, and I'm very profitable on my long call. What I will do in that example a lot of times is sell my long call and roll it up to a new long call, making my spread tighter, but taking some profit on the call option that I initially started with. So that is more of an example, and if I got some time, I'll go through that, and I will look at an example like that using call options. Okay, so let's go to here, show you the QR code. If you are not a member, please do put your phone up right now, scan the QR code, or go to optionsplay.com/signup. And that's my ugly mug, which you should be looking at anyways. My X handle is at Brian Overby. Here's the OptionsPlay website. It makes it very hard when it's OptionsPlay and my book's Options Playbook. But this is the website that I was drawing your attention to today. And if you have any questions, we'll try to address them right now. I'm going to back out, take a little bit of a drink of water. And let's look at our JP Morgan example. Okay. All right, so before the show started, I went out and I put in the covered call position on JP Morgan. But I'm going to adjust this position. So if you can put this in, this is a paper trade, and you have this is the paper trading portfolio. I'll show you on the other side of things, we have the daily play portfolio, and then we have the paper trade. And I just called this portfolio JP Morgan covered call. All right. Now, if I click on this, it puts the underlying stock over on this side, and I can click close this position. All right. So I want to paint a scenario. So you're going to have to hang with me, and you might have to watch this twice. The recording is available. You can find it on YouTube. It'll be available to all. But I'm just going to get rid of the stock here. Okay. And let's look at these other scenarios. Let's say we started 22 days out, which is more than enough on JP Morgan. I don't mind being 22 days out on JP Morgan because it's a fairly high price stock. Once again, they just announced earnings, so I'm just looking to try to bring in some premium, and we brought in a decent amount of premium. The cost, you can bring in $2 for going out 22 days. All right, now let's change this up. Let's pretend that the stock is, here's where it's at right now, 268. So in this instance, and I picked the stock in particular because we can look at the 265 and we can look at the 270 strike. So if we say the 265 strike call, let's say we fell asleep and our option contract got in the money. Okay, so ignore that we did this over here. here's what our roll would be. We are going to look at the 265 strike call. We would be buying to close that call. And we notice now that that is trading for $7. Oh, let's go a little bit closer. Let's make it 8 days remaining. 1 day would be kind of egregious. Yeah, let's say 1 day remaining. Okay. We might be able to roll that one though. But now we got to pay $3.34 for that option contract. We are in the money. We are in danger of being called away, and we'd be called away at $2.65, $3.23 below. Now I'm going to add a leg, and this would be our roll. This would be our sell. So if we're going to do this, we'll try to go out 8 days. Because once again, you want your double down to go away. If I'm at the blackjack table, I don't want to have to double down 2 or 3 or 4 times to try to get back to even, right? I put my $5 up, I lose. I double down, I go $10, I lose. Now I'm down 15. Now I got to go $15. I lose, right? I just want this headache to go away. So I eventually want to win as quick as I possibly can. And so when I'm rolling this is exactly what I want to do. I want to go out as far or as little amount in time as feasible and still try to get this done for a net credit to the account. So in this instance, here's a great example. I can go up to the 270 strike, which doesn't give my stock much room to run. I go out to the February contract. I can't get that done for a net credit to the account. I'm still paying a very hefty debit. Let's call it 90 cents approximately. All right. So now I got to go out to a different expiration. So I'm going to go out to the February expiration. Now I look at that. Now I can do it for even 15 days out. I'm still only giving myself a couple of bucks worth of upside, but now I can go out to the 15-day option contract and I might break even. Well, maybe I want a little bit more credit than that. So now if I look at the 270 and let's say I want to get a little bit of upside. So now I'm going to go to the 275. Well, I guess I can do the 272. Let's do that. So the 272 strike call, and then I'm going to give myself from 268 to 272. All right, well, that looks a little bit more feasible, right? In this instance, I give myself a little bit more upside, but gosh darn it, now I got to go out further in time. So let's click this and see where we can get enough premium for that. And this is what I mean about up and out, the most popular thing to do. Now it's not 22 days, that's not going to do it. Now I have to go all the way out to the February 20. Oh gosh, that's not going to do it. Now I got to go out to March. Yeah, so now I got to go out 36 days to give myself a little bit of upside on this underlying, on my stock. To give myself another 7 points approximately of upside on the stock, I'm going to have to wait 36 days and I'm going to bring in another 30 cents on my covered call position. Right? I started out, I did it for a cost basis of $2, let's call it. I had to buy it back. I had to pay $3.34. So I'm down to $1.34. The only way that I can double down and break even. I want to give my stock some upside. I don't want to go through this again, a little bit later on. So I roll out to the March contract, 36 days away. It's still within my parameters. And I got to go to the 275 strike, and then I can only bring in another 30 cents. And I'm not necessarily looking at this like, I really want that 30 cents, right? I'm like, I don't want the cheese anymore. Just let me out of the trap. And that's what I'm really looking to do when I do the covered call position. Now, don't forget, you're really taking a loss on this option contract, and the stock can still go down. But this is one of the more common ways to do this roll if that situation was there. Now, let's go back and let's look at a better situation where you have the preemptive roll. All right. So in this scenario, we're going to keep that January expiration. Let's get rid of this one. We'll start over again. And now with the stock at 268.25, it really behooves you to think about it. And this is when I would think about rolling the position. I don't want to play the hope game. I hope it stays below 270. I hope it stays below 270. I hope it stays below 270, right? I want to do something about it. And if I'm very nervous about getting a sign, let's say I worked at JP Morgan, I've owned the stock for years and years and years and years, right? First of all, I might not do a covered call on it. But with that said, in that scenario, I don't want to be assigned. I don't want to give up the stock and have to pay taxes on that scenario. All right, so stock is approaching 270. Let's add a leg. Now let's look at it. Let's look at that same scenario. Let's go out to the 36 option contract and cut to the chase, right? We want to give ourselves a little bit of upside. We said 275, right? Did we say, gosh, I thought it might have been, all right, we'll keep it right there. I don't know what happened to that strike. February 29th. But now if we go all the way out to here, first of all, we're only paying 48 cents. There's no intrinsic value. There's only 1 day remaining. We can easily do this in this scenario where we're paying that 48 cents. If we go out to here, now we're actually bringing in real numbers. So by buying this one preemptively, we could probably go all the way down to the 14 strike. And we look at the February 14, we can probably do the 270, there we go, 270, 250. And now I'm once again bringing in real money, almost as much as I was looking to do on the initial trade. And this isn't the same strikes, but in the concept, you're bringing in about $2 to do the trade. So in this instance, I can actually bring in, we'll call it $1.75 approximately by doing the roll. Once again, I'm doing it preemptively. I could even go all the way down to the February 7th expiration, and I can still get this done. So in this instance, managing your rolls before they get into money, especially if you don't want to be assigned, can make a lot of sense in your option trading. And if there's one thing that you take away from this, that would be the biggest thing to take away. Preemptive rolling is way easier to do than after the fact rolling. So my general rule is if it hits the strike, that's when I want to roll. If I do a preemptive roll, I'm really trying to avoid it. But if it hits the strike, I want to roll. And if it gets more than 1 or 2% in the money, and once again, it depends on the underlying. If it's a more volatile underlying, it can run a little bit more because there's more time premium in the further out option contract that you're trying to sell. But if it gets 1 to 2% in the money, then you have to roll. Because if you let it get 5 or 6 or 7% in the money, you almost for sure cannot roll to a decent strike price and get it done for a net credit to the account. All right, I got a whole boatload of questions that are just popping in all over the place. All right, so let's try to address the questions and then we'll leave it there. I thought it would be a short seminar, but man, I got a lot of questions in here. So we're going to go all the way up. Joe, we'll do a wheel strategy. I can't do the wheel right now. All right, but this obviously applies. And thanks for the question. Answer live, done. Answer live, done. Ron says, what will we do with the UPS butterfly, Ron? You sell it and you make some good money on it. You don't do anything with it. So Ron was talking about our daily play, and we can look at that position. We got short a butterfly yesterday ahead of earnings, which is a very speculative play that we don't do that often. And we were bearish on UPS, and UPS is down 14% today. So this is all that you're going to do, Ron. You're going to go on in and click close the position and close it and get out of it. Yeah, and winner chicken dinner. It's always risky though, and I don't ever want to just toot the horn on winning trades, right? Because if you're looking at earnings, anything can happen. But there is rationale that was behind that. Screen is black, no PowerPoint. Okay, what is the goal in terms of bringing in income with a covered call? This one comes from Warren. If I'm looking at the type of premium, there is times where a covered call doesn't make sense. And I'll just think about something that I was doing recently in OptionsPlay as one of the daily plays that we send out. And XLF, it's a index, or XLE. No. XLF is financial. XLF is the financials. And I really wanted to sell some calls because the position was down a little bit on it, but there just wasn't enough premium. You were looking at 20 cents, 30 cents, just a couple of points out of the money in order to, you're saying I'm going to give up the stock and I'm only going to get 20 cents on it for doing that. So there are times where I feel that there's just not enough implied volatility premium in the option contracts in order to sell the call. So I always like to say with covered call selling, you want some volatility with some predictability, right? I don't, that's an oxymoron to start with, like jumbo shrimp, for example. So if you're looking at that and you're doing that type of trade, I would rather do a covered call in JP Morgan or a stock that's a little bit lower price, Charles Schwab, which was a recent trade that I did around earnings too. But with Charles Schwab, you have an $80 stock and you're going to get some premium because it trades at a 27% vol, where the XLF trades down around a 20% vol. You just don't get enough premium in order to make it worth your while. So in this instance, if I'm looking at it, JP Morgan, we're bringing in $2, going out a few weeks in time. I'd say, I don't know if I can put a percentage on it. Maybe 1%, 1 to 2%. 1% would be one heck of a dividend in 14 days, right? If you're thinking of it that way. But it's just more so to me about what type of volatility is in the underlying in order to do it. I know it wasn't a perfect answer, but there's no golden book of answers, I guess, when it comes to it. Is it advisable to be option sellers or buyers morning right after earnings with the eyeball crush? Okay, so I have one from Min Lee, and Min Lee is asking, does it make sense to try to be an option seller right after earnings? I don't know about that. I'll just put it this way. I try to avoid earnings when I'm selling options, just in general. I don't mind. I do a lot of butterflies around earnings, and like the one that we just talked about in United Parcel Service. And I want to do things where implied volatility comes in, and a butterfly is profitable when implied volatility comes down. I feel like you have to have the position on, though, before the earnings report. Now, with that said, I don't mind coming out, and let's say JP Morgan was a great example. It was a stock that I was bullish on. And so they announced earnings. They did pretty well after their earnings, and a lot of the investment banking firms did. So as soon as that report comes out, I don't mind selling a call. I'll say it that way. I'm not going to just sell the call to try to take the volatility crunch, because you still got a lot of movement. People are still digesting things, right? And the risk reward usually on call selling or short call spreads or short put spreads is still there. It's still real. It takes a few days for it to filter out. But I don't mind selling a call option where I own the stock, and if the stock gets up to that level, I can roll it or I can adjust it. So that's the way I would look at it, but I don't want to do as speculative trade because the volatility crush is real and usually happens right away. So I guess the answer in short is no. I don't want to do that. I don't mind selling a covered call on a stock I own. Okay, how does rolling a covered call affect the purchase date and sell price for tax purposes? There's a lot in that. Sometimes you can take with taxes and you can try to add the cost basis into your ownership of the stock, and that's really hard to do. There's no really good answer on trying to track the cost basis, but some people can do that. And I'm not a tax advisor. I just give my taxes to someone and I let them do it. That's simple. Ernest wants the poor man covered call. We're going to get into that. We're going to start looking at our portfolio, Ernest, on the stock outperformer, where we're doing the poor man's covered call, which I call inside the playbook the fig leaf. That's the name that I gave for the strategy. Oh, also known as a diagonal spread. Look up the fig leaf option play. Make sure you put option play or you get a lot of weird stuff in there, Ernest. Joshua, thanks for the great question. But basically, Joshua, when you ask that question, you're kind of saying, well, I drove off the car off the cliff. Is it okay to take it to the auto mechanic and repair it? Because if the stock gets way deep in the money on your call position and you have a lot of time, it's very hard to do. You either, in that scenario, I'd usually just close everything and start over. That's simple. How do we exercise our option contract? Joey, you can exercise if you would like to. You call your broker and say, I want to exercise it early. So if the stock is paying a dividend and it's a large dividend, you want to go out and exercise early before the dividend gets paid, and you want to pay attention to the ex-dividend date, but you have to call your broker. Very few brokers allow you to exercise without calling. In other words, they have the feature built into the platform because it doesn't happen that often. There's not a lot of demand for it. Like I showed, I think the number was 11% inside the options playbook of people that want to exercise their option contracts before the expiration date or even at the expiration date. Well, and then the other thing I guess I could talk about, like in our scenario, we painted the picture on covered call selling as a buy right. And that, once again, that comes from the writing of an option contract and being the seller or the underwriter of the contract. A lot of people will buy stock and then sell a call. They very rarely send it to the trading floor as a buy and a sell at the same time. And here's the main reason why is that when you buy the stock, most of the time, you think the stock's going to go up, right? That's why you bought it. So why sell a call and cap your upside right away? I usually will sell my calls at a later date, but there are some systems, like somebody mentioned the wheel system, where you're automatically doing it because you're focusing on call premium more than you are on what's happening to the stock. So we're going to get into the wheel strategy here eventually. That's going to come. Okay, so Vince asks a little bit about a spread, and I guess I'll address it. Is it best practice to buy calls 90 days out and sell calls 30 days out, and then roll the call? Yeah, that's not necessarily the best practice, but it is something that somebody would do. That's called a diagonal spread. And I have a tendency, I just recently did a diagonal spread in what underlying? I think I did it last night, actually. DXCM. Okay, so here's an example. Once again, you guys are seeing the inner workings of options play. This is part of our portfolio that we put out and part of our daily plays. But in this instance, we on Dexicom, they're going to be announcing earnings. So I buy the expiration that has earnings, and it might be counterintuitive because you're paying for it, right? So implied volatility is up. And then you sell an expiration that doesn't have earnings. Now, here's the whole thing here is that buying the longer term option contract, you expect implied volatility to be your friend all the way up until it's not, all the way up until that date. So this is actually a diagonal spread. We bought the 88 strike, sold the 90 strike. We want the stock to go up towards 90, and it made a good strong move today. That's why the position is up. But in that instance, you want it to stop short of 90, and then you get your 88 calls at a cheaper price, and you hope that implied volatility increases. Now, in this scenario, if I'm up on the position, I don't want to ride it all the way through earnings. I just hope I get the bump up in implied volatility. I get this option to expire worthless, bringing in about $1 to the trade, and I can make a few dollars on a trade where I'm bullish on the underlying stock because they still need the stock to go up. If it goes down, it doesn't help at all, right? And I don't want to write it into the risk of the earnings report. So I get a bump up in implied volatility. I hope it doesn't reach this strike and this expires worthless. And then I can sell this at a decent price prior to the earnings. I'm not looking to hit a home run. I'm not looking to make $20, $30 to $40, right? You're trying to make a couple of dollars on your $3.25 cost basis. Hope that answered that question. All right, gosh, I'm going a little long. So let me go back to the slides. Let's put this slide up. If you'd like to know where we're at, what we're doing, please, you can follow me on x.com. I'll let you know. OptionsPlay website, sign up for the free trial. You either use the QR code or go to the URL. And my book is Options Playbook. And with that said, I'll answer a couple of more. I see a couple that are in the chat that are fairly long. So let me look at this. Okay, I bought NVIDIA 112 put with the January 31st expiration. Price of NVIDIA today is 125. If I'm understanding, I don't have to close this and can just let it expire to get my premium, or is there okay, so you're mixing metaphors a little bit, James. You're saying that you bought to open a put. That means you paid for it. And NVIDIA is 125. So the put's going to expire worthless. You got the 112 and the stock's at 125. Because if you exercise and sell the put, you'd be selling the stock, you'd be selling it at 112, not at 125. So you're going to lose the premium unless you can close it and receive something. But I don't mind that trade, because if I'm nervous about NVIDIA and I was thinking about selling it, what you had on in this situation is you had on a protected put. If you own stock, I'm assuming you might have owned stock, but I don't know why I'm assuming that. And then, so what would you do here? In this instance, I would just close the position. If you can sell it and get anything, that's fine, but there's not going to be too much to roll because you're a little bit out of the money in this scenario with not that much time remaining. So all you want to do here in this scenario is either, if you can close it and get something, go ahead, but you're not really looking to roll the position. If you want to get bearish on NVIDIA again, close this one out, find a better entry point, and then decide when you want to do that. There is a section in the playbook about rolling puts too, just so you know. Roger says, does the same principles apply to rolling verticals and diagonals? I would say yes, Roger. Just in general, if you're going to roll anything and it gets too deep into money, it doesn't become worth doing. And if it gets too far out of the money, just like in our put example that we just talked about, it's not worth doing either. You don't want to do something just to do something, right? So sometimes you just got to take your comeuppance and move on. So if you're going to adjust anything, you usually want the stock to be somewhere close to the strike price. And part of the reason why is that that's where all the premium is. That's where all the action is. The markets are very liquid. It's easier to make adjustments on the trade, and there's something to adjust. You want time if you are wrong on a position, you want time premium in your options. Carl, thank you. Yes, XYZ is going to be an issue that now it is no longer a fictitious stock. It is actually Block Trading or Block Incorporated. It used to be known as Square, and they changed the symbol to XYZ, which is really annoying. So the only one out there, I think, is ABC. I don't think anybody's taken that one yet. Commissions are something I don't really address. That's a broker thing, but commissions are fairly feasible. But Tamara asked about commissions. Oh my gosh, I don't think I can get through all of them. Okay, OptionsPlay. Out there to gain access to the recording and the slides, go along with the full OptionPlay platform. You can sign up for free at optionsplay.com/sign up. So if you go to this URL, you can get the slides. I knew that answer, but I had forgotten it. The book is not free, Bob, but the website is free, and all the text from the website is on. All the text from the book is on the website. But I own the book now. I used to not own it, but I do now. I own all the rights to Options Playbook now. I used to work for Ally Invest, and they were a great firm, an awesome firm. Honestly, loved working for them. All right, I can't even get through them. There are too many, everybody. Thank you so much for all the questions and everything. I hope you enjoyed this. If you have any questions, you can send them to support@optionsplay.com. And if they are, sent to me, a lot of times I will try to address them, but I don't do this on a daily basis, go in and check all the emails. But support@optionsplay.com if you have any questions. And we'll see you soon. We'll be back. We'll be looking at a wheel strategy. We'll be looking at a few other things, but this is a very important strategy that I don't think is covered very well out in the YouTube space. So I wanted to take the time to do it. Thanks for stopping in, and hopefully we'll see you soon.